US stocks are rallying this morning on easing fears of a US recession. The Aussie dollar jumped after a speech seen as hawkish from RBA Governor Michele Bullock. The Reserve Bank of India holds rates hawkishly, and New Zealand inflation expectations drop. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Economist Dhiraj Nim explains why India's success in reaching a sustainable current account deficit is masking much needed underinvestment.
Currently at about 1% of GDP and occasionally even lower, current account deficit is quite low. I argue that at such low levels, while it is good for external stability, it also reflects that we have been foregoing an opportunity.
But first, in 5 and 5 with ANZ, US stocks are up around 2% this morning after stronger than expected jobs data for the first week of August eased some fears of a US recession. That also saw bond yields rise 5 to 6 basis points as market expectations for Fed rate cuts this year eased a bit. The US 10-year yield rose back above 4% for the first time this month. Initial jobless claims in the week to August the 3rd came in at 223,000. Now, that was less than the consensus for 240,000. So jobless claims means fewer people made unemployed. And it was also below the previous week's revised figure for 250,000. Here's ANZ economist Bansi Madhavani from London this morning.
When we smoothen it out, we see that labour market is indeed cooling gradually, and claims are now just a touch higher than their 2022 level. That is a welcome sign, especially as investors feared labour market deterioration and a US recession just at the start of the week. As of 4 a.m. Sydney-Melbourne time, the Aussie dollar was up 1.1% at 65.91 US cents, while the Kiwi was up only 0.2% at 60.05 cents. That meant the Kiwi fell 0.9% against the Aussie to 91.14 Aussie cents. Number 2. Now, the main reason for that jump in the Aussie dollar was a speech yesterday from the Governor of the Reserve Bank of Australia, Michele Bullock, which was interpreted as being quite hawkish. She pointed out in the speech the board considered hiking on Tuesday, but in the end went for a hold. Here's Michele Bullock in her speech yesterday at the Rotary Club of Armidale.
But the board does remain vigilant to upside risks on inflation, and it won't hesitate to raise rates if it needs to. Now, I know this is not what people want to hear, but the alternative of high inflation is worse. It hurts everyone, and I think everyone sees that now when everyone is concerned about the cost of living.
So Michele Bullock there saying she won't hesitate to hike. Number 3. Forecasters' inflation expectations in New Zealand dipped again in the third quarter, with the 2-year ahead reading falling from 2.33% to 2.03%. That's pretty much bang on the midpoint of the Reserve Bank of New Zealand's 1 to 3% target range. ANZ New Zealand chief economist Sharon Zollner says that's what the Reserve Bank would have wanted to see.
Now, inflation expectations in and of themselves won't cause inflation to fall, but it does suggest that inflation expectations are not going to get in the way of inflation falling. So we don't think it's a game changer for the Reserve Bank. It might be maybe a little bit softer than they might have expected, but this isn't the sort of thing they would even actually bother forecasting. It's more of a credibility check, and they got the big tick.
Number 4. The Reserve Bank of India held rates at 6.5% as expected yesterday. ANZ economist Dhiraj Nim says the RBA governor defended a hawkish stance on inflation, which is being led by food prices, something that monetary policy has less of an influence on.
He mentioned that high and persistent food price shocks have risks of spilling over to the non-food baskets, which in general can create problems for future inflation and growth. So therefore, to ensure stability of growth, to ensure that household inflation expectations remain benign, the Reserve Bank of India remains focused on headline inflation. This also means that the Reserve Bank of India is comfortable waiting for food inflation to subside before they can be confident that they are achieving the inflation target. We therefore do not expect any rate cut before December 2024.
Number 5. Japanese markets have settled down after a turbulent week. The yen fell overnight against the US dollar to 147.28 yen to the dollar. And the Nikkei fell only 0.8% as a summary of opinions from the Bank of Japan's July board meeting was released. ANZ FX analyst Felix Ryan says the summary indicates the July hike of 15 basis points was viewed very much as an adjustment to inflation trends and not traditional tightening designed to slow the economy.
Also as well, there was some discussion around what the neutral rate may or may not be. It seems that 1% was given as a rough indication of what the neutral rate could be. So in terms of getting back to neutral, it was really stressed that it would be a gradual and timely rate rise, not an aggressive tightening campaign like we saw with central banks across the world in 2022 and 2023. Certainly there was a lot of caution around further rate hikes.
Felix Ryan there. Now, in our bonus deep dive interview, ANZ Economist Dhiraj Nim talked to my colleague Alex Tarrant about how India's success in cutting its current account deficit has created a lost opportunity for capital investment in manufacturing.
One of the key changes on the current account front for India has been that the current account deficit, which was perhaps a marker of external risks we were facing a decade ago when we were a part of the fragile five economies, has substantially narrowed, which seems to reflect tremendously improved external stability for the economy. Now, about 2013-14, we had the current account deficit hitting close to 5% of GDP, which was clearly not sustainable, and it had, on the back of the taper tantrum crisis, made India be viewed from a lens of high-risk economy. But currently at about 1% of GDP and occasionally even lower, current account deficit is quite low. I argue that at such low levels, while it is good for external stability, it also reflects that we have been foregoing an opportunity in terms of investment rate, which could have been much higher than what it currently is. Now, it's a bit counterintuitive because we've been always saying that India's growth is led by investment spending, and here we are saying that it could be even better. One of the key reasons why the current account has narrowed over the last decade, and quite substantially so, is because the private business capex has not grown at a sufficient pace. Not at least at a pace where an economy like India, which is still low capital per worker economy, will need it to be.
The underinvestment that you're seeing, how is that showing through, the persistent underinvestment?
So if you look at various accounts of the economy in terms of the three key economic agents, the government, the firms, and the households, and you look at their respective savings investment gaps, which eventually add up to the economy's current account deficit, we do find that over the last 10 years, the saving investment gaps for the firms has been rising. They used to borrow in net terms about 2% of GDP from the rest of the world to fund their investments, but they now currently are sitting on a bit of a surplus. So the savings rate is higher than their investment rate. And this probably is for various reasons, like I said, one of which could be the strong rise of the services sector in the economy, and service sector tends to be much less capital intensive than manufacturing, among other things. And I think that this particular number in the positive territory is something that we need to be mindful of, because we still want our manufacturing sector to grow because it has the capacity to absorb large number of youth and workforce in general, but we also want that to incur a capex cycle which is healthy. Now, for all of that to materialize, a lot will need to go right, but this is how at least it's shaping up in the economy right now.
Just looking at that services manufacturing split, India has sort of been expressly saying it wants to increase manufacturing, maybe take manufacturing business off China. And so is that looking like happening, or what needs to happen for that to be triggered? And then what will the effect be on the current account?
To be honest, the kind of geopolitical backdrop we have has already set the ball rolling in terms of India looking like an attractive destination for supply chains that are shifting out of China. At the same time, the domestic policy focus is timely in the sense that we are announcing policies and incentives and schemes to attract these businesses, especially when they're looking to diversify their production bases. However, on the negative side, what has happened in the last few years because of low inflation in China, China's currency has become super competitive on a real effective basis, and that perhaps is curtailing the domestic manufacturing recovery even in India. And I'm sure this could be a story in a lot of other Asian economies as well. So in India, we see that a lot of low-tech manufacturing, which accounts for about 15% of the total manufacturing output, their output levels are still about 10 to 20% below the pre-pandemic levels. That's quite a sharp negative shock. And one of the reasons could be cheaper goods from China, which are also reflecting in widened trade deficit with China. So India has about $100 billion worth of annual trade deficit with China, and we've added about $40 billion of that just in the last 3 years alone. In all, what I'm trying to say that there is no easy fix to this problem, and there's a complex demand problem lying beneath restrained manufacturing capex in the economy. But if it were to pick up, then I think that India's current account deficit could rise to about 2.5% of GDP, which is a healthy level by our analysis.
Dhiraj Nim there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, August the 9th. Catch you next week with the Reserve Bank of New Zealand's August monetary policy statement and a live rate review. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.